Welcome to chapter 10. We are going to go over plant assets, natural resources, as well as some intangible assets. All right. Let's go ahead. We're going to talk about depreciation methods, and we're going to talk about how to handle intangible assets, things like that. We're not going to exchange of plant assets for the appendix. Yeah, I think we're going to just skip that. Don't worry about that. So the first part, we're going to measure property, plant, equipment. How do we do that when we purchase them? Example of property, plant, equipment would be land, buildings, equipment, all these things you'd see all listed on this slide. I would like to point out, though, that land does not get depreciated. All right. So when you buy land, it's just a matter of keeping it. You can have depreciation, or sorry, land held for future use, which would be a different aspect. But if you have a land that has a building on it and you're working in that building, you're just going to hold that land and you're going to test for impairment. But we don't get into impairment testing in this course, so don't worry about it. Just know that we do not depreciate it. Depreciation follows the matching principle. Remember how we buy an asset, we have to expense it as we use it. Since an asset like a vehicle or equipment hopefully lasts us longer than a year, we have to kind of break up its costs over that useful life. So we can't just expense the full amount that we paid for those things in the year we bought it. We have to break it up. And that's what depreciation ultimately is doing, is breaking up the cost of whatever it did to whatever we paid for it in order to allocate those costs. And here's an example. You buy the asset, we use the asset, we dispose of the asset. We could sell the asset, we could just drive it over to the junk heap and just leave it parked there or something. I mean, bottom line is, one way or another, we're not keeping assets forever unless it's land. We could do that, but then we don't appreciate that. Cost principle, we got to record our assets at what we actually paid for it, not fair market value. Sometimes we use appraised value and fair market value in order to account for the total cost, but we don't say, well, I bought this land and it really is worth this, so we're going to put it down as that. No, it's whatever we paid for it, what actually paid for it. And what do we pay for it? Well, the purchase price, naturally. However, things like surveys and legal fees, filing, taxes, only if they're delinquent and you had to pay them in order to get it up to buy it. The cost of grading, clearing, basically doing anything horizontal on the land is going to be put into the cost of the land or the land improvements. What we're not going to include are things that are improving the land, such as fencing, paving, or anything that's kind of vertical. If we're got to go up or we got to go down, then those are going to be something separate, called land improvements. And we do have this as part of this section, but these are land improvements that we're looking at here. And those are subject to depreciation because, unlike land that hopefully is just going to be the land no matter what, the lighting, the sprinkler systems, paving, all those things eventually need to get replaced, fixed, or disposed of. So let's look at this. We bought land for $50,000. We also had property taxes, transfer taxes, removal of a building that's on there, as well as a survey fee. We're going to put all of that towards the cost of the land. Now, if we had something on there that said paving or putting lighting in or some kind of water system, all that's going to be land improvements. All right. So the cost of our land here is going to be $62,000 when we add all these together. Land, when we do the journal entry to record it, we're going to debit land because it's an asset, and then we're going to credit whatever means it took us to get that. And apparently here we financed $50,000 and we had a $12,000 down payment. I would like to go back a slide and point out removal of buildings. See, I know that may kind of sound vertical, but its bottom line is you're grading the whole land. You're taking down, removing anything that's in the way. All of that gets put into land. I just wanted to make sure I emphasize that. So when we say that these costs are capitalized, what that just means is that we're going to, they're subject to depreciation. So you either expense costs or you capitalize costs. And think about inventory when we talked about it in Accounting 111 or earlier this year. if you're in accounting 211. Inventory, when we buy it, we capitalize it in the sense that we're putting it on our balance sheet until we sell it. So there's that aspect of it too. I guess capitalizing that isn't very, it's not the right wording of it, but you get the point. It's still an asset until you move it off. You don't expense it until you use it or sell it. All right, the fencing, paving, lighting stuff we've been talking about, those are land improvements. We're going to debit those for the 20,000 credit cash. That's the journal entry for that. Okay, building costs, any kind of things here too. I don't see real estate, but that may have been thrown into land, but buildings could also have that. Anything that gets it to where you're actually making the purchase and getting it is going to be included in your building account and subject to depreciation. Machinery and equipment, purchase price, of course, transaction charges, sales tax, installation, testing, as long as it's prior to use of the asset. Once the asset's put in place and is beginning to manufacture, any testing after that, like if something breaks and gets fixed and testing done on then, those will be all fall under repairs and maintenance. They are an expense that you're going to expense in that accounting period. But all this information here and anything that is subject to getting that machine into a usable or the equipment into a usable position will be capitalized as part of the asset. Furnitures and fixtures, you got all these different things. Again, any delivery costs, anything that gets it ready for its intended use. In many cases, what companies will do to save money is they're going to make these lump sum purchases. They also are called basket purchases, I guess. I've never heard it called basket's only been lump sum. But what we have to do when we have that situation, unless you pay the actual value of what you're buying as these lump sum, you're not getting any discount. We have to do is we have to then consider what the market value is for each one of these things. So in this case, we're paying $100,000 for a piece of land in a building. So we're going to find out what they are together for market value. Market value is 120,000 total. The land was 30,000. The building was 90,000. We're going to come up with a ratio. Oops, I hit my keyboard. We're going to come up with a ratio where it's 30,000 divided by 120 to find out what percentage the land value is to the total purchase. And then the same thing for the building for finding out its percentage. Once we do that, we'll apply the $100,000 to each of the percentages to find out what we're going to put as part of the purchase price towards those assets. And here's an example of this. So you see our market values there on the second column. The percentage of the total value is 30 over 120,000 for the land. That's 25%. And building is 90,000 over 120,000. Again, that's your fair market value. But we only paid 100,000, so we did not pay full market value for those assets. So we're going to take that 25% and multiply it by the purchase price to come up with our land amount, and then 75% towards our building. Those totals equal 25,000 and 75,000 respectively. So our journal entry will look like this: debit land for 25,000, debit building for 75,000, we'll credit the notes payable for 100,000. This is how you do a lump sum purchase. It doesn't matter if you have 2 or 20 assets, you're going to do this exact same exercise for each time. And if you're in my 112 class, this is our first chapter we're covering after our review of accounting 111. I would caution you from not doing problems 2 or 3 times the homework. Right now, you can build good habits. Right now, you can do the work ahead of time so that you are successful later on down the road. If you're not understanding this concept, but man, you got that homework right and you click submit, you can walk away and pat yourself on the back, or you can do it again and again and again until you understand it. All right. And I highly recommend that. Spend the time and focus on your studies. It's very important. All right. Capital expenditures versus revenue expenditures. Capital expenditures are basically things that are going to increase the life of the asset or its efficiency. Any revenue expenditure is basically to keep it working as is. All right. So in this case, if we rebuild an engine, okay, we take out the engine of the car or truck and we rebuild it and put it back in there, that engine can be brand new, or whatever the circumstance is. All of a sudden, the engine really is your workable part of the car, right? And you have some other parts too, like your carburetor and your transmission and things that would still have that wear and tear. But your engine's what drives the car, and so therefore, if you spend $3,000 to rebuild an engine, you're going to extend that normal life of that asset, right? So we're going to put that $3,000 into that cost, and we're going to have to reevaluate the spending, or sorry, the depreciation on that asset. On the other hand, if we go into this one, if we're just paying to replace the tires on the truck, those are just repair maintenance. Okay, just keeping it going as is. Got to have tires, got to keep it going. We need oil, got to put it in there. Oil change, expenditure, revenue expenditure. Okay, that's the difference. Something that improves the life or the efficiency of an asset will increase, or will be a capital expenditure. And if it is something just to keep it going, like these tires, it's going to be a revenue expenditure, just expensing it on the income statement. Here are your different aspects of each one. You can pause the video to look at these and try and not just read these and be like, okay, I understand a vehicle. Think about what the equivalent would be on a piece of machinery. Maybe you're making bottles of Dr. Pepper. If you are, then I love you, right? But think about how this would impact other types of assets as well, not just a vehicle. Like, think of a building. How would you extend the life of a building? So that's kind of what we have to do as accountants. We get the rule, or we get the understanding. How do we apply it to these other things that we have to deal with? As hopefully something that everybody knows, we do data analytics and accounting. Just having information, being able to analyze information and use that for predictability will help us with our profits. Okay. Just kind of wanted to let you know about all that. Now we're going to get into the meat and potatoes of this chapter, which is the depreciation, the calculation, and how to do it. I'm going to teach you 3 methods, but it should be clear that there are more than 3 methods of depreciation. You can pretty much use any type of depreciation method as long as you have a justifiable reason for it. So there's one called Makers that's tax related. I don't know that they let you use it anymore. I can't remember. It's a form of accelerated depreciation, but it's very different. If that makes more sense for your company for some reason, you can do it, but you have to explain that when when you're doing your financial statements, and the auditors are coming and saying, hey, why are you using this method instead of something that's officially GAAP approved? As long as you have a good answer, shouldn't be a problem, because ultimately, as you will see, it doesn't matter which method you use in these, you're going to get to the same answer over the life of the asset. Oh, I was playing with my remote. No, it's not moving there. Okay. So what we need is the capitalized cost, all the amounts of money that we are going to be considering for expensing it over the life, the useful life, the residual value. And if we're using the units of production method, we're going to need to know how many units we anticipate the piece of machinery or whatever we're depreciating will produce. Here are the 3 methods we're going to learn in this class. Know that there, like I said, there are other methods too. There's one that's called the sum of years digits. I remember learning that. It made no sense, but I mean, it was fun to calculate, but it made no sense why anyone would use it. Maybe that's why we stopped teaching it, because at least all 3 of these, you kind of say, yeah, I get why we would use it, but sum of years digits. So again, just something someone dreamed up one time, probably. Here is your method: cost minus residual value divided by useful life. All right. So in this situation with this truck, I guess we're going to take 41,000 minus the residual value of 1,000. Now, if I say salvage value, that's the same thing as residual value. Some people call it residual, some people call it salvage. Means the same thing. It's like saying tomatoes, tomatoes, or potatoes, potatoes. It's the same thing, just different way of saying it. So after doing this calculation, taking the cost minus the salvage value, dividing it by that useful life, this truck's going to have an 8-year depreciation expense going through it. So each year we're going to make the same journal entry that you see at the bottom of the screen. Each year will be the same number, that same journal entry for 5 years. Then we're going to dispose of the vehicle. After year one, we've depreciated it once. We're going to debit the depreciation expense, credit the accumulated depreciation account, which hopefully you remember is a contra asset account tied to whichever piece of property, plant, and equipment that we are depreciating. In this case, the truck. So when we look at this, we're looking for our book value, which is going to be the net of the amount of the truck with the accumulated depreciation. So net of the accumulated depreciation, our truck's value or book value is $33,000. That's after year one. After year two, the accumulated depreciation would be 16,000, and then the truck's net would be affected thusly to $25,000, and so forth until the last year we're depreciating it. Here's an example of what we're looking at. It's a good structure to follow if you want to use to do your depreciation schedules for straight line. The straight line method is the easiest, and that's why 95% of companies use it. Every year we do these companies that we review, and every year when I ask which depreciation method the companies use, everyone says it's the FIFO method. I'm sorry, the straight line method. I was thinking of inventory. So I don't anticipate many companies really using anything other than straight line. Okay, units of production. Bottom line is we need to do a calculation to find out what units, dollars per unit that we expect our equipment or whatever we're using to that it's gonna. Okay, so like if we have a piece of machinery, we expect we're gonna be able to make 1,000,000 units from it. All right, well, how much did it cost? Well, it cost 100,000. So cost per unit, we're gonna take the cost 100,000 divided by 1,000,000 units. I think that's 10 cents a unit. So that's what we do when we're calculating the per unit cost. Then as we make the units, we depreciate this asset thusly as we go through it. It matches the expected wear and tear on the vehicle or sorry, the asset, whatever we're using. So in this case, we're creating units, I think. Well, oh no, it's still the truck. So we're doing it based on mileage. We think we're going to use. Okay, it says expects to drive the truck 20,000 miles the first year, 30 the second, 25 the third, for a total of. So we expect we're going to drive this truck 100,000 miles before we kick it to the curb. So we're going to take the cost minus the salvage or the residual value, that's 40,000, divided by 100,000 miles, which is the output we expect, and divide, and that gives us 40 cents per mile. So as we go through each year, no matter how many, well, no matter what, we got to find out how much we actually drove this truck for, how much we produced to determine what our expense could be. Now, in this situation, it's very similar. I mean, we got the same number of 8,000 for our depreciation because we actually hit that 20,000 miles. So that's the step 2 here. Let's look at our production here. And all of the amounts of the production is going to be given to you in any problem because obviously we can't expect you to just make it out of thin air, otherwise we wouldn't know the answer. But units of production schedule is thus each depreciable unit is 40 cents. Multiplying it by the actual number of, in this case, miles driven. First year we drove 20, then 30, then 25, 15, and 10,000. As you go through, you're depreciating it. And the last year you depreciate it only until you get down to the residual value of $1,000. It is possible that in 2030, that last year, we could have driven that vehicle 15,000 miles. Okay, but we can still only depreciate it using the 10,000 in this scenario because we cannot depreciate lower than the residual value. We cannot do it under any circumstance. We cannot depreciate it under residual value. And think about it. How do you know how many miles you're going to drive on a vehicle? 5 years later, you don't. You have no clue. The truck might break down in year 4, and you're going to have to just write it off at that point. You don't know. You're giving it your best shot. It's an accounting estimate. So the odds of you actually landing straight on the number of units you're going to produce with it is like slim to none. You just need to be in the ballpark, okay? In fact, you can even be in the ballpark and you could be like just in the parking lot, not actually in the stadium. As long as you're there, it's fine. But if you're trying to be in Chase Field and you decide to drive to China, good luck driving there, by the way. But the point is that you can be ridiculous with your estimate. At which point, then the IRS and the SEC is going to be like, he thinks you are not doing it with good faith. All right, the accelerated method is the double declining balance method. I do not like this method. It's complicated. It's not that complicated. I mean, it's just once you get your spreadsheet going, it's fine. But it's just I don't like it. I just don't like it. It doesn't make sense for it to be as complicated as it is, and unless there's a really good reason for it, whatever. All right, so we need to take our cost minus our accumulated depreciation, which is our book value. And in year one, it's going to be 0. We're going to multiply it by 2 and then multiply that by 1 divided by the useful life. In this case, it was 5 years, which is 20%. So we're going to take the 41,000 in year one, multiply that by 40% and then by 2, and we're going to get 16,400. Then in year 2, we're going to have our depreciation, our book value, which would be 41,000 minus 16,400, which is 24,600, and then multiply that by 2, and then that by 40% or 20. I'm sorry, it's 20% all of this round, but the times 2 is what gets it to 40%. I apologize, I misspoke there. It's because they're presenting it a little different than I'm used to presenting it. In this, I present it as taking the rate of 1 divided by 5, or 20%, and doubling that. That's where the times 2 comes from. So 40% of book value from the beginning of the accounting period. That's how you calculate it. I think that's a little more clear than what they're showing you here, but it's very formula related here, so you can see that as well. And here is the schedule for how to depreciate it. Notice that last year in 2030, it says that there's an asterisk there. It says this is a plug figure needed to reduce book value to the residual amount. That's kind of how it works. Double declining balance methods does not get you right where you need to be, like the straight line method does. And really the units of production method doesn't get you there either, unless it's academic and they make it that way. Now, here's why it really doesn't matter unless you're factoring in time value of money or whatever. Because look at what you're going to get to. Total accumulated depreciation for each method is going to get you to the same exact amount. Straight line method is just going to be consistent. You're going to be fine throughout the years. Units of production is going to follow the actual usage of the product more closely. But the accelerated method is going to give you more revenue in the early years. Sorry, it doesn't. I'm sorry. It says produces more revenue in early years. I don't think that's really true. It's just that you're going to have less net income because you're expensing more in the first earlier years. I don't know how it produces more revenue using the freaking double declining balance method there. That's maybe you guys could tell me, you entrepreneurs, how does whether or not I use the accelerated depreciation method give me produce more revenues in the early years? That's ridiculous. Absolutely ridiculous, because it doesn't impact revenues, it impacts expenses, and it decreases net income. Really weird. Some of the things Pearson says kind of out there, in my opinion. I don't always agree with them. But the bottom line is we get to the same book value every time, just different depreciation amounts per year, but we get to the same thing. Oh, look, we do have the makers telling you about the tax situation here. It's not acceptable for GAAP, but like I said, though, as long as you can justify it, it's fine. But it's not the GAAP approved method of depreciation. Partial year depreciation, you just calculate the annual amount and then divide by 12 and multiply it by the number of months. Okay. Sometimes there's also things called the half month convention, half quarter convention, half year convention, and that's because when we look at these assets in their singularity, yeah, it's really easy to calculate, track, and do that stuff with these assets. But you got to think that, if you're dealing with Microsoft or Boeing or bigger companies like that, they have a just ton of assets. And so what they will typically do is they'll either do group depreciation, or they will do the, like I said, the half year or half whatever convention. And that is that whenever an asset gets placed into service, whatever year that is, whether it's January or December, doesn't matter. They're going to take a half year or half quarter, whatever, half month convention on that. So if the annual depreciation for that asset would have been 100,000, they're only going to take 50,000 in the first, and then the last year that it's in service, and then everything in between will be the same amount. I dealt with an organization and several entities that did that. It's not wrong. It doesn't, in my opinion, again, it just doesn't matter. It's just that's how some people do it. I want to emphasize this because you're going to have a memo you're going to do. This is called the change of a depreciable asset, changing estimates of a depreciable asset. Bottom line is that only thing that really will change is, well, if you make an improvement on it, then yeah, then the amount will. But usually it's the useful life, the residual value, that is going to get changed. So one of those two things are going to be impacted. You have to recompute, but also remove what you've already used. So in this example, we have our straight line depreciation method. What are they trying to do here? Yeah, this is what we were calculating. Okay. The remaining depreciable book, okay, it was 25,000 in this situation, but then we believe that the truck's remaining useful life is 6 more years. So a total of 8. So what we have to do is take our book value minus the residual value at this point and divide it by the amount we have left. And so we're going to adjust our book value, or excuse me, our depreciation expense to that 4,000. You're going to do a memo on this trying to explain to a president the impact of this, because in this case, the asset's going to go longer. But I think in the memo, or, I'm actually thinking about having several different options, but you got to look and see is if the asset depreciates faster, it's going to increase that depreciation expense. If it depreciates slower, sorry, if it depreciates faster, it's going to decrease your net income. If it depreciates slower, it's going to increase net income. Your president needs to know what's going on, because if everything else is held constant, all of a sudden net income's fluctuating, you got to be able to communicate that. And that's what that exercise is doing. So going forward, not back, you don't have to fix it in the start of 2028. You don't go back and rechange everything because you did it in good faith before. You're just changing the estimate now. You're going to just alter future depreciation expenses by the amount of what you just calculated. How we report it on the balance sheet is going to be less the accumulated depreciation. Here's an example of a partial balance sheet showing the property, plant, and equipment section. You notice it shows the building kind of on the inside, with the accumulated depreciation underneath it and the book value off to the right. This is how you'll typically see it. Sometimes you'll see in the second treatment there, but it just says property, plant, and equipment, and it just says net. It's saying that that's net of all of the accumulated depreciation. Both ways are approved, because the first way, if you can track your assets very meticulously, great, you can do it that way. But a lot of these companies have so much, they just can't break out their it wouldn't be the cost benefit principle wouldn't benefit them for anything, so they just show it the bottom way. All right, take a breath. Here we go. This is a long chapter. We're dealing a lot with these assets, so it's kind of a lot. The next thing we're going to talk about is how we dispose of these plant assets. But I guess before we could do that, we can do the word for the day is updog. Sorry, not updog. Parkour. 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 Park and R. Our, like our job is fun. Papa Alpha Romeo Kilo Oscar Umbrella Romeo Parkour Parkour. Please put that word in the quiz to get credit for watching this video. Okay, so we can discard it, sell it, or exchange it for another asset. Well, however we do it, we're going to depend on what we need to do. If we're just discarding it, we're just taking it to the dump. It's going to debit the accumulated depreciation, credit the equipment. Now, if it's fully depreciated, that's great. If it's not fully depreciated, any difference in what you haven't depreciated yet will be a loss in this situation of just discarding the asset. Bottom line is, as you see the ledger accounts here, equipment has a debit balance of 10,000 and the accumulated depreciation has a credit balance of 10,000. We're just going to debit and credit both of those to get it to zero, and the equipment is gone. It's just off our books. We may need to, on our final discarding of it, that we need to include depreciation amount. So like at the end of its useful life, maybe we depreciate it the last time and then we dispose of it, whatever the case is, you'll go ahead and do that. But in this circumstance, if we actually do this in July, we're going to go ahead and look and see what happens, because we only increased the accumulated depreciation by $500 instead of $2,000 for some reason. And under this circumstance, now we're going to have a loss when we dispose of it, because we had $10,000 as our cost and we've only expensed 8,500 of it. So the remaining amount we're going to put on our income statement as a loss on the disposal of this asset. Here's our journal entry. We're going to debit accumulated depreciation for the equipment, debit loss on disposal, and then credit equipment. Now, what if the company sells this instead of disposing of it? And how much are we getting for it? I guess it doesn't tell us yet. So in this case, again, it's July 1st. If we're selling it, okay, we're gonna record our last bit of depreciation, and then we're gonna get on to the next step, which in this case sells the equipment for $1,500. Suppose that Smart Touch Learning sells the equipment for $1,500, and then it says market value of assets received is $4,000. That should have been $4,000 that they. Oh, the market value of assets received should have been $1,500. That's a typo on Pearson's part. That should be $1,500. So that is the market value of what we're receiving. We sell the equipment and all we get is $1,500 cash. Market value of the cash is $1,500. So that's a typo there. But cost minus accumulated depreciation, we have 5,000 or 1,500, and then we're going to reduce it by the 1,500 to give us a zero gain or loss. We sold it to without any of those. Okay, so yeah, as I was looking at this again, I paused the video just to make sure I got this right. 4,000 minus 1,500 does not equal zero, so they definitely got this one incorrect. Our journal entry to record this will be a debit to cash for 1,500, debit to accumulated depreciation for 8,500, and a credit to the equipment for $10,000. Now, what if they sold it for $4,000? Well, now we're selling it at a gain because we're getting more than what we have left to depreciate, which in this case is 1,500. So 4,000 minus 1,500, we're going to see a gain of $2,500. Under this circumstance, the journal entry will be the same, except cash is now 4,000 and the gain is 2,500. Now, what if we suppose? Remember to pause these videos if you guys need to like look at the slide and really know it. I just don't want these videos to be 100 years long. Suppose that we sell it for $500. Now we're going to have a loss. Everything else stays the same, but instead of getting a lot of money, we get a little bit of money. Now we have a loss of $1,000. Same exact journal entry, except now cash is 500 and we're debiting loss on disposal, not gain. So here's a summary of the circumstances that we saw, and you can pause the video to have a look-see at this. And then I'm going to click the next, and here are the different journal entries under those different circumstances. Accounting for natural resources. The bottom line is, if you know how to do the units of production method, you know how to do this. Instead of depreciation per unit, we're looking for depletion per unit. Everything has changed from depreciation to depletion. We don't depreciate stuff. We're just depleting it. We're taking it out of the ground. We're getting barrels of oil or pounds or tons of gold or silver or whatever. So we take the cost minus the residual value divided by the estimated total units to get our per unit amount. And then as we pull any of whatever we're extracting out, we're going to multiply the number of what we pulled out by that rate. And so it's, again, it's identical to the units of production method. And like I said, instead of depreciation, it's depletion expense, credit accumulated depreciation. See, I said again, depletion. On the balance sheet, you're going to see it as oil reserves or whatever the natural resource is, less its accumulated depletion. Okay, last thing we're going to talk about is intangible assets. What is an intangible asset? It is basically anything that gives a benefit to a company that doesn't take physical form, all right? So you can have a patent, right? So the patent says I get to use or do something or make something exclusively, okay? Now, the piece of paper that tells me that information is only the piece of paper and only costs a penny or whatever it is. But it's the value of the fact that I have the exclusive rights to do what it is I'm doing with the patent that gives me the benefit. It is, you can't hold that in your hand. Like think of a trademark or a symbol or a logo. Like when you see Nike swoosh, you don't think, wow, that cloth right there on that shoe is valuable. It's not. It's the symbol when you see the Nike swoosh that you think Nike, that you think what they are, who they are. The value is derived that way. Other things that might confuse you that is an example of an intangible asset could be uh, a water rights or there's some I wanted to bring up. I'm brain farting right now. Well, bottom line is anything that like music. Like if I compose music, right? The value is in the rights to that music or a painting. The oil and the brushes and stuff that was used to create this work of art, it's not the cost of that, it's the value of the fact that I now own a Rembrandt or a Picasso or something, you know. So that's where the value comes in, and that's where the asset, the intangible aspect of that is. Okay. So most of our assets that are intangible, we're going to amortize over what we expect its useful life for. If it does not have a useful or like it has its life is not calculated, like if you own something that just is never going to like go away, like I own this music rights, nobody else can have them except me. Maybe it's an indefinite life. You're going to test it for impairment. Another intangible asset, I don't even think it was this year's goodwill, right? Goodwill is a very common asset that companies have when they purchase another company. If they pay more for it than its assets that they're buying, then they are basically giving them more for it. That's called goodwill. And that's all that is tested for impairment and not amortized. I remember when we did amortize goodwill, but then they changed that rule. I think because it's an expense, people were spending a lot of money on it instead of giving you fair value for whatever you're buying. Anyway, I don't know. I just was guessing. Okay, so anything that is indefinite, like I said, you test for impairment. Don't worry about impairment testing, you just know that it exists. Okay. Here's the thing, and I want to emphasize this on patent because I think you have a homework question on this. If you have the rights for 20 years on a patent, but you're only expecting to really have an exclusive advantage or be able to really use that exclusively for 15 years, you take the 15 years and you're going to amortize it over 15 years, not the 20. So if I have exclusive rights to something, but I know in 10 years something's going to happen that's going to basically make the last 10 years worthless for me, like advanced in technology or something, then I can do it less and amortize it under a less amount. Buy a patent, debit 200,000, credit cash 200,000. You could also create it from your R&D. That's also possible, but it would be very similar to this. Amortization cost minus what you expect if you could sell it at all. A lot of times it's going to be zero, right? But it even says right here, most intangibles residual value will be zero. divided by its useful life. So in this case, useful life of the patent is determined to be 5 years, even though it looked like 20 years, right? It said here, grant conveying an exclusive 20-year right to produce and sell an invention. I don't know why the government's giving us that. Government didn't invent anything. But the bottom line is they got 20 years, but now they're saying, well, it's really only be good for 5. So we're going to amortize that for less. This is the exception of this chapter, right? We've been doing the accumulated depreciation, depletion. Now we're just going to reduce the value of the patent. All right, we're going to debit our amortization expense, patent, create the patent as a reduce the value of that patent. And who knows? By the time you guys become accountants and are out doing the thing, they could change this to where you have accumulated amortization expense patent. You know, who knows? I don't know if there what value you would really need to do that, to track that, but you know, technically long-term assets are supposed to be held at cost, and this is reducing that cost. So maybe that'll change someday. Who knows? Other examples, copyrights, trademarks. This one gives you the Nike swoosh here, the golden arches. Although if you didn't know this, Sedona is the only place on the face of the earth where the golden arches are green. If you didn't know that, go look it up. It's pretty crazy. I've seen it. I've been there. Legally protected slogans like Chevrolet's Like a Rock and De Beers at Diamonds River. I had no idea that you can copyright a slogan like that. Like I can't go out there and say like a rock, I'll get arrested, right? No, I can't use it for marketing and things like that. A diamond is forever. And diamonds are technically not forever. They do wear out eventually. I'm just being stupid now. Okay. Franchises, licenses. Oh yeah, here's goodwill. Okay. It's the value paid above the net worth of the company's assets and liabilities. There you go. I think I just said assets before, but yeah, it's basically when you overpay for the equity of the company. Goodwill's not amortized. Like I said, it was tested for impairment. Now we're going to show you this. Just know it. Don't study it. Don't learn it. Don't, you know, I'm not going to give you any questions on this. I don't think. If I do, just let me know and I'll get rid of it. But anyway, that's kind of how it works. You bought Mocha for 10 million. The value of Mocha's assets was 9 million, but the liabilities were 1 million. So 8 million was really the equity of the company, and we spent 10 million when goodwill's 2 million. Kind of what we're talking about here. Boom, there you go. Okay. All right. Oh, this is fun. I like this one. Reporting of intangible assets. And we list plant assets, natural resources, and intangible. Whatever. It should have just said overview. So asset turnover ratio. Just know how to get a formula and know how to do it. Okay. That's really what you need to do. Net sales divided by the average total assets. You take the average by taking the beginning balance plus the ending balance and dividing it by 2. That's how you do it. So for PepsiCo's annual report in 2021, the asset turnover ratio is 80 or 0.86. Okay. So we're turning over the assets 0.86 times, not quite once. Okay. And then there's the appendix. We're going to just through this. I'm not going to go over this. You have access to these slides if you really want to go over those. If you have any questions, please let me know. Otherwise, you guys have a good one. We'll see you in future videos, but also remember to put that word into the quiz so that you get credit for watching the video. You guys have a good one. We'll see you guys in the next video.